Listen, I need you to pay very close attention to what I'm about to tell you, because what's happening in the silver market right now is something most investors won't see coming until it's too late. And by then, the opportunity will be gone. We're standing at a moment that only comes around once every few decades. The kind of moment where fortunes are made by those who act and lost by those who hesitate. And you've got about 48 hours to decide which side of that equation you're going to be on. Now, I know what you're thinking. You've heard urgent warnings before. You've seen the headlines. But this time is different, and I'm going to prove it to you with hard data, historical precedent, and what's actually happening behind closed doors in the silver market right now. Let me start by painting you a picture of what just happened. Silver jumped from around $29 per ounce to over $64 in a single year. That's a 120% surge. But here's what nobody's talking about. This wasn't speculation. This wasn't retail investors piling in. This was driven by something far more fundamental, far more powerful, and far more sustainable than any speculative bubble. For the 5th consecutive year, we're in a global silver supply deficit. Think about that for a second. 5 years in a row where the world has consumed more silver than it produced. That's not a blip. That's not an anomaly. That's a structural shift in the market that's been building for years, and it's finally reaching a breaking point. Industrial demand hit record levels. We're not talking about jewelry or investment demand here. We're talking about solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems. The technologies that are supposed to define our future all have one thing in common. They need silver. Lots of it. And there's not enough to go around. But here's where it gets really interesting. While industrial demand was soaring, something else was happening. Inventories were shrinking. The COMEX warehouses, the London vaults, the ETF holdings, all of them started showing signs of stress. Physical silver was becoming harder and harder to source at these prices. Now, let me take you back in history for a moment, because if you understand what happened before, you'll understand why the next 48 hours matter so much. In 1979, silver was trading around $6 per ounce. Within a year, it hit $50. That's more than a 700% increase. But that wasn't just the Hunt brothers trying to corner the market, though that's the story everyone tells. What really happened was a perfect storm of inflation fears, currency debasement, and a supply crunch that made silver the most sought-after asset in the world. When that bubble burst, silver crashed. But here's what's different this time. In 1980, industrial demand for silver was minimal. Silver was primarily a monetary metal and a jewelry component. Today, industrial demand accounts for more than half of all silver consumption. And unlike investment demand, which can evaporate overnight, industrial demand is sticky. Once a solar panel manufacturer builds a factory, they need silver every single day to keep that factory running. Let me give you another historical parallel. In 2008, during the financial crisis, silver dropped to around $9 per ounce. By 2011, it had climbed to nearly $50 again. That's a 450% gain in less than 3 years. But again, that rally was driven primarily by investment demand and fear. When the fear subsided, silver fell back down. What we're seeing now is different. This rally is being driven by structural factors that aren't going away. The world is electrifying. Every electric vehicle requires about twice as much silver as a traditional car. Every solar panel installation requires silver paste for the photovoltaic cells. Every 5G tower, every data center, every smartphone, they all need silver. And here's the kicker. There's no substitute. Engineers have tried. They've looked at copper, at aluminum, at various alloys. But for high-efficiency electrical conductivity, for the specific applications where silver is used, there's simply no replacement that works as well at any price point that makes sense. So we've got surging demand that's not going away, and we've got supply that can't keep up. But that's just the beginning of the story. Let me tell you what's happening with the mining companies right now. Silver production has been essentially flat for years. Why? Because most silver isn't mined as a primary product. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. So when copper prices are low, or when zinc mines shut down, silver production falls too, regardless of how high the silver price goes. And here's something most people don't realize. It takes 7 to 10 years to bring a new mine online. Even if silver prices stay at these elevated levels, even if mining companies wanted to dramatically increase production, they couldn't do it quickly. The supply response is slow, while demand is accelerating. Now let's talk about what the big players are doing, because this is where it gets really revealing. Central banks have been accumulating gold for years. Everyone knows that. But what's flying under the radar is what's happening in the silver market. Institutional investors, the smart money, they're positioning themselves in silver in ways we haven't seen before. Look at the ETF flows. After years of outflows, we're starting to see institutional money come back into silver ETFs. But more importantly, look at what's happening in the physical market. Premiums for physical silver over the spot price have been elevated for months. That tells you something crucial. There's a disconnect between the paper market and the physical market. In the paper market, on the COMEX, you can trade contracts representing millions of ounces of silver. But when it comes time to actually deliver physical metal, that's when the cracks start to show. Delivery delays, higher premiums, tighter supplies. The paper market says one thing, but the physical market is telling a different story. And here's why that matters for you. When that disconnect becomes too large, when the paper market can no longer suppress the physical reality, that's when prices explode. We saw it in 2011. We saw it in 2020 during the Reddit silver squeeze attempt. And we're seeing the early signs of it again now. Let me paint you a scenario. Imagine you're a solar panel manufacturer. You've got contracts to fulfill, factories to run, workers to pay. You need silver to make your panels. But when you go to buy physical silver, you're told there's a 6-week delay. Or the premium over spot price has doubled. What do? You pay whatever it takes, because shutting down your factory costs far more than paying up for silver. Now, multiply that across every industry that needs silver. Electric vehicle manufacturers, electronics companies, medical device makers, defense contractors. They all need silver, and they all need it now. That creates a bidding war for physical metal that the paper market can't control. Speaking of things the market can't control, let's talk about what's happening geopolitically, because this is adding fuel to an already raging fire. The BRICS nations have been making noise about moving away from the dollar for years, but recently those plans have become more concrete. They're talking about a commodity-backed currency, and while gold gets most of the attention, silver is part of that conversation too. Why? Because silver is more accessible. It's cheaper per ounce, which makes it more practical for everyday transactions. It's more abundant than gold, but still scarce enough to hold value. And it has that industrial demand component that makes it inherently valuable beyond just being a monetary metal. If even a fraction of global trade starts settling in commodities instead of dollars, the demand for physical silver could explode overnight. And remember, we're already in a supply deficit. We're already struggling to meet current demand. Adding monetary demand on top of industrial demand would create a shortage unlike anything we've seen in modern times. Now, I want to take a quick aside here because if you're sitting on retirement savings of $100,000 or more, this next part is specifically for you. I've put together a comprehensive guide on how gold IRAs work, and it's available in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, how the process works, and what you need to know to protect your wealth. If that's relevant to your situation, it's worth checking out. But let's get back to why the next 48 hours matter so much. Here's what's about to happen. We're approaching a critical technical level in the silver market. After that massive run-up to $64, silver has been consolidating. It's been building a base. And every technical analyst worth their salt is watching the same levels, waiting for the same breakout. When silver breaks above its recent consolidation range, it's going to trigger a wave of algorithmic buying. Hedge funds, commodity trading advisors, momentum traders, they all have systems that automatically buy when certain price levels are breached. That creates a self-reinforcing cycle where buying begets more buying. But here's the thing. That breakout is imminent. We're talking days, not weeks. And once it happens, the opportunity to get in at current prices will be gone. You'll be chasing the market higher, paying more for the same ounces you could have bought today. Let me tell you a story about a guy I know. Back in 2010, he was watching silver trade around $18 per ounce. He did his research, he understood the fundamentals, he knew it was undervalued, but he hesitated. He wanted to wait for a pullback. He wanted to get a better price. By the time he finally pulled the trigger, silver was at $35. He still made money, but he left a fortune on the table because he waited. Don't be that guy. Now, let's talk about the supply side in more detail because this is where the story gets even more compelling. The largest silver-producing countries are Mexico, Peru, China, and Australia. But here's what's happening. Production in Mexico has been declining. environmental regulations, community opposition to mining, aging mines that are becoming less productive. Peru has similar issues, plus political instability that's making it harder to operate mines profitably. China, the world's third largest producer, has been keeping more of its silver domestically. They're not exporting as much as they used to because their own industrial demand is soaring. They're building solar farms, electric vehicle factories, electronics manufacturing plants. They need that silver for themselves. And Australia, while still a major producer, can't ramp up production fast enough to offset the declines elsewhere. So we've got declining production in some regions, flat production in others, and no major new mines coming online in the near term. Meanwhile, demand is accelerating. Do you see the problem? Let me give you some specific numbers to drive this home. Global silver demand is projected to exceed 1.2 billion ounces. Global mine production is around 830 million ounces. That's a deficit of nearly 400 million ounces that has to come from somewhere. Where does it come from? Recycling, government stockpiles, and above-ground inventories. But here's the issue. Recycling can only provide so much. Government stockpiles are already depleted in many countries, and above-ground inventories are shrinking fast. The COMEX warehouses held over 400 million ounces of silver a few years ago. Today, that number is significantly lower. The London vaults are seeing similar drawdowns. The silver that's available for immediate delivery is becoming scarcer by the day. And this is where the paper market becomes really interesting. On the COMEX, there are contracts representing far more silver than actually exists in the warehouses. It's a fractional reserve system, just like banking. As long as most contract holders settle in cash rather than demanding physical delivery, the system works fine. But what happens when more people start demanding physical delivery? What happens when industrial users, worried about supply shortages, start taking delivery instead of rolling their contracts forward? The system breaks down. And when it breaks down, prices go vertical. We saw a glimpse of this during the 2020 silver squeeze. Retail investors, coordinating online, started buying physical silver and silver ETFs in massive quantities. Premiums spiked, dealers ran out of inventory, the U.S. Mint had to ration silver eagles, and the price jumped from $18 to nearly $30 in a matter of weeks. But that was just retail investors. Imagine what happens when institutional players, when industrial users, when sovereign wealth funds start competing for physical silver. The price action would make 2020 look like a minor blip. Now let's talk about the elephant in the room: inflation and currency debasement. Central banks around the world have printed trillions in new currency over the past few years. The money supply has exploded, and while inflation has moderated from its peaks, it's still running well above historical averages in most developed countries. When people lose faith in paper currency, they turn to hard assets. Gold and silver have been money for thousands of years. They can't be printed, they can't be debased, they hold their value over time. But here's why silver might be even more attractive than gold in this environment: the gold to silver ratio. Historically, this ratio has averaged around 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. But recently, that ratio has been much higher, sometimes exceeding 80 to 1 or even 90 to 1. What does that tell you? It tells you that silver is undervalued relative to gold. And when that ratio reverts to its historical mean, silver has to either rise faster than gold or gold has to fall. Given the fundamentals we've discussed, which scenario seems more likely? Let me give you another historical example. In 2011, when silver hit its peak near $50, the gold to silver ratio was around 30 to 1. Silver was expensive relative to gold. Today, even after the recent rally, silver is still relatively cheap compared to gold. That suggests there's significant upside potential if we see a reversion to historical norms. But beyond the technical ratios, beyond the supply and demand fundamentals, there's something else happening that's even more profound. We're witnessing a transition in the global monetary system. The dollar's dominance is being challenged. Not tomorrow, not next week, but the process has begun. And when that transition accelerates, when countries start diversifying away from dollar reserves, precious metals are going to be the primary beneficiaries. Silver, with its dual role as both an industrial metal and a monetary metal, is uniquely positioned to benefit from this transition. It's useful in the real economy, which gives it intrinsic value, but it's also scarce and durable, which makes it suitable as a store of value. Think about what happened in the 1970s. The U.S. went off the gold standard in 1971. The dollar was no longer backed by gold. What happened next? Inflation soared. Gold went from $35 per ounce to over $800. Silver went from $150 to $50. People who held precious metals preserved their wealth. People who held cash saw their purchasing power evaporate. We're in a similar moment now. The monetary system is changing. The rules are being rewritten. And the people who understand what's happening, who position themselves accordingly, are going to come out ahead. But here's the critical point. You have to act before the crowd figures it out. Once silver is on the front page of every financial publication, once your neighbor is talking about it at dinner parties, it's too late to get in at good prices. The big moves happen before the mainstream catches on. Let me tell you about the smart money, the institutional investors who move markets. They don't wait for confirmation. They don't wait for everyone else to validate their thesis. They do their research, they make their decision, and they act. And right now, they're accumulating silver. Look at the positioning in the futures market. Commercial hedgers, the producers and industrial users who actually deal in physical silver, they've reduced their short positions significantly. That's a bullish signal. It means they're less worried about prices falling and more concerned about securing supply. Meanwhile, large speculators, the hedge funds and commodity traders, they're building long positions. They're betting on higher prices. And these aren't retail investors gambling with small amounts. These are sophisticated players managing billions of dollars, and they're putting serious money into silver. The options market is telling a similar story. Call option volume, bets on higher prices, has been increasing, and the strike prices being purchased are well above current levels. These traders are positioning for a significant move higher, and they're willing to pay for that exposure. Now, let's talk about what could go wrong, because I want to be balanced here. What are the risks? The biggest risk is a global economic slowdown that's severe enough to crush industrial demand. If factories shut down, if solar panel installations grind to a halt, if electric vehicle production collapses, then silver demand would fall. But here's the thing. Even in that scenario, monetary demand for silver would likely increase as people seek safe havens. And given the supply deficit we're already in, even a modest decline in industrial demand wouldn't necessarily lead to lower prices. Another risk is a major technological breakthrough that provides a viable substitute for silver in key applications. But as I mentioned earlier, engineers have been trying to find substitutes for decades, and they haven't succeeded. Silver's unique properties make it irreplaceable in most of its critical uses. A third risk is government intervention. If silver prices rise too quickly, governments could impose export restrictions, windfall taxes on mining companies, or other measures to control prices. We've seen this happen with other commodities. But such interventions typically only delay the inevitable and often make the eventual price spike even more dramatic. So yes, there are risks. But when you weigh those risks against the potential rewards, when you look at the fundamental supply-demand imbalance, when you consider the monetary system transition we're going through, the risk-reward ratio is heavily skewed to the upside. Let me bring this back to you personally. Why should you care about any of this? Why does it matter? If you're saving for retirement, if you're trying to preserve wealth, if you're concerned about inflation eroding your purchasing power, silver offers a solution. It's a tangible asset that you can hold in your hand. It can't be hacked, it can't be frozen by a bank, it can't be inflated away by a central bank. But more than that, we're at a unique moment where silver is still affordable for average investors. At current prices, you can buy meaningful quantities of physical silver without needing to be wealthy. Compare that to gold, where a single ounce costs thousands of dollars. Silver is accessible. And if the thesis I've laid out plays out, if we see silver move back toward its historical highs or beyond, the percentage gains could be life-changing. We're not talking about 10% or 20% returns. We're talking about the potential for multiples of your initial investment. But here's why the 48-hour window matters. We're at a critical juncture. The technical setup is there. The fundamental backdrop is there. The institutional positioning is there. All the pieces are in place for a significant move higher. And once that move begins, once silver breaks out of its current range, the easy money will be made. Think about it this way. Would you rather buy silver at $30 per ounce or chase it at $50? Would you rather position yourself before the breakout or after? The difference between those two decisions could be tens of thousands of dollars in profit, or more, depending on the size of your position. I've been studying markets for years, and I can tell you that opportunities like this don't come around often. When all the stars align, when fundamentals, technicals, and sentiment all point in the same direction, that's when you need to act. The silver market is giving you a gift right now. It's giving you time to make a decision, to do your research, to position yourself before the crowd arrives. But that window is closing. Fast. In 48 hours, the market could look very different. The breakout could have happened. The momentum traders could have piled in. The premiums on physical silver could have spiked. And you'll be left wondering why you didn't act when you had the chance. So here's what I want you to do. Don't take my word for any of this. Do your own research. Look at the supply and demand data. Study the historical precedents. Watch what the smart money is doing. And then make your decision. But make it soon. Because the clock is ticking, and the silver market waits for no one. This isn't about fear. This isn't about panic. This is about recognizing a rare opportunity and having the courage to act on it. The people who build wealth, who preserve their purchasing power, who come out ahead in times of monetary transition, they're the ones who see what's coming and position themselves accordingly. Silver is telling you a story right now. It's a story about supply shortages, about industrial demand, about monetary system change, about wealth preservation. The question is, are you listening? The next 48 hours could define your financial future, not because silver is going to make you rich overnight, but because positioning yourself correctly before a major move can set you up for years of financial security. Think about where you want to be a year from now. Do you want to be looking back, wishing you had acted? Or do you want to be counting your gains, grateful that you recognized the opportunity when it presented itself? The choice is yours, but the window is closing. And once it closes, it won't open again at these prices. Silver has been money for 5,000 years. It's been a store of value, a medium of exchange, a unit of account. And now, in our modern world, it's also an indispensable industrial metal. That combination of monetary and industrial demand is what makes this moment so special. We're not going to see another setup like this for years, maybe decades. The supply deficit, the industrial demand surge, the monetary system transition, the technical breakout setup, they're all happening at the same time. That's rare. That's special. And that's why you need to pay attention. I've given you the data. I've shown you the historical parallels. I've explained what the smart money is doing. Now it's up to you to decide what to do with that information. But remember, in markets, hesitation is expensive. The people who wait for perfect confirmation, who want absolute certainty before they act, they're the ones who miss the big moves. The people who do their homework, trust their analysis, and act with conviction, they're the ones who profit. So ask yourself, what's your conviction level? Do you believe the supply-demand fundamentals are real? Do you believe industrial demand will continue to grow? Do you believe the monetary system is changing? If you answered yes to those questions, then you know what you need to do. The 48-hour warning isn't about creating panic. It's about creating urgency. Because opportunities like this don't wait around. They don't send you a reminder email. They don't give you a second chance at the same price. Silver is at a crossroads, and so are you. The path you choose in the next 48 hours could determine whether you're a spectator or a participant in one of the most significant commodity moves of this decade. Make your choice. Do your research, and act accordingly. Because when you look back on this moment years from now, you'll either be grateful you acted or regretful that you didn't. The silver market is speaking. The question is, are you ready to listen?